All I'm saying is that you better buckle up because this could easily turn into the craziest week of the trading year. You ready for this one? We've technically got the 10 and 30-year bond auction, CPI, PPI, FOMC, the updated SEP, Jerome Powell speaks, then it's into retail sales, unemployment claims, PMIs, 2 AI-sensitive earning reports, and to top it all off on Friday, it's the quad-witching expiration. Did you catch all that? It's absolute insanity. So, let's certainly expect some increased volatility out there and build a game plan based on logic to keep us on the right side of the trade. As always, check out the links listed down below in the description. Hit the thumbs up button and subscribe if you've not already done so, and stay tuned until the end of today's show. I've got 2 additional trade ideas to share with you that you won't want to miss. With that said, let's jump right into the charts. So kicking things off and slowing things down, over on the SPY weekly time frame chart, what do we see from a candle structure and location point of view? Structurally, I mean, this is like deja vu, a rinse and repeat, a copy and paste of the previous weekly bar. Solid green body with just a little bit of a lower wick, indicating that the buyers stepped up near those lows and they were able to close prices near the highs of the weekly range. Overall, structurally, buyers are in control. If we think about location, on the bar-to-bar count, a very nuanced higher low and a very nuanced higher high. They're both there, though, so buyers go 2 for 2 on the weekly count. Let's explore that nuance just a little bit further, though, because this is starting to become an indication that momentum is slowing down. Oh my gosh, gasp, right? That is not, let's be very clear, that is not the same thing, though, as saying it looks like a weekly pullback is imminent. As we just discussed, candle structure is bullish. We do not have a large upper wick. We didn't close red. We didn't close underneath the previous weekly low. As a matter of fact, we actually closed for the first time on the weekly chart up and over the summer highs. So the buyers do remain in control, but momentum is slowing down. This is worth pointing out because it's a character change from what we had experienced down here off the lows from the reversal, and what I would argue over here was the break up and over the trend line, right? You can see every single bar-to-bar count produced a major higher high. This one, just nuanced. It is there, but it is nuanced and small. In terms of the lows were basically unchanged from the previous weekly close. Unchanged from the previous weekly close, same thing here, same thing here. This week, we opened closer to the open as compared to the previous weekly close, and what that would indicate is that the buyers had to exert even more effort just to produce a very nuanced and small higher high. So we're pointing out this character change because technical analysis is all about subtle shifts in market context. Again, it doesn't mean that we need to pull back aggressively, but if it's going to start foreshadowing that the market's changing its tone a bit here, is it possible we should be prepared with pullback levels underneath the lows of the daily range that we'll see in just a moment? Absolutely. Absolutely. And we're pulling back from the highest high, so it's totally reasonable the market could be searching for a higher low. What are the levels? They're all the same levels that we've discussed in last week's episode, 451.10 as the breakout level from here. It's also a daily breakout level. In terms of the bottom of the double inside bar range, we know that there's confluence there at 441 with the CPI gap close. Then your line in the sand structurally on the weekly time frame chart is here at 437.35, and that's coming from the double top neckline, which kicked off the weekly downtrend in the first place here, and we've already used it for a lower high retest over here. So that's your line in the sand. You can't really look at the weekly chart and say that we're still in a clean uptrend if we're underneath 437.35 on a pullback. But we're actually getting much more confluence out of 441, and let me show you why. If we take a look with our anchored VWAPs on the weekly time frame chart, the cluster is sitting at 439.88. And obviously, because these are volume-weighted average prices, they will continue to drift in the upward direction the more volume that transacts near these highs. So it wouldn't be unreasonable to say that they're going to basically be at 441 come the open of this coming week's worth of trade. The next thing we could take a look at is the Fibonacci from the October low all the way on up to the most recent high. Notice that your 38.2, let's not split hairs here, is 4 cents off of 441. 440.96 is the number. Again, beautiful confluence with the CPI gap close. What this would indicate is, again, if there is a pullback underneath these lows on the weekly chart, then this is still game on for a weekly uptrend. Healthy bull flag consolidation, and over time, we will look for that breakout to continue. Let's take a look at our last weekly indication, the volume profile. And because we've been saying that there is no indication of a pullback, let's talk about a target first, and then we'll talk about pullback levels, right? Obviously, this is a flat top. Structurally, it was resistance, 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 and we're sitting right on it. If we were to break that, it would also be clearing this volume shelf right here, and the next target overhead comes from a high volume node and a flat top. You'll notice the previous resistance and a little bit of a rejection in the upper wick of the green inverted hammer at 471. That's your upside target. And then to bring it full circle, pullback levels, your volume point of control is closer to your 38.2 and the CPI gap close around 441, right? So all things considered, the weekly chart momentum looks to be slowing down. It certainly could pick back up with any of the volatility events that we rattled off in the intro there. But if we do start to see a pullback underneath these levels, we know that we're well prepared with plenty of reference points underneath. Let's take a look at the daily. On the daily time frame chart, let's first evaluate this week's expected move. If you're not familiar with this study, check out the video tutorial in the top right-hand corner. If we're contained by the upper bound, the number's at 466.95. Let's call that 467, and that of course would imply a big time higher high. If we're contained by the lower bound, the number's 453.09, and that's basically on par with equal lows to the bottom of our daily balance area here. So expected move does strike me as being bullish. The overall trend does remain up on the daily time frame chart. We just produced a brand new higher high on the Friday session, but let's count from the CPI gap up. We have lows, higher lows, higher lows. Remember that we flipped into an hourly downtrend on the Wednesday session of 2 weeks ago, and the low was cemented on the Thursday session after we broke to a higher high on Friday. Now, just like we had deja vu on the weekly chart, it's the same thing in last week's worth of trade. Wednesday flips into an hourly downtrend. Technically speaking, it's a higher low, and that's really what produces the nuanced weekly bar-to-bar higher low, right? So higher low as compared to the Thursday of 2 weeks ago, and then we see a recovery effort on Thursday, and Friday breaks up and over both of the equal highs to produce the highest high. So the buyers are in control on the daily chart. Things are looking bullish finally, with on Thursday a higher low being produced intraday up and over 456.30. We have the higher high, and we're breaking out of this as a balance range. So the buyers are in control. In terms of upper targets, we know that we have 461 and 465.75, but there is a hidden target in between at 464. I'm sure you know why if you've been tuned into the channel for any period of time. You know that when we break out of a balance range, we typically look to double that range, and that brings us as a measured move into 464. It's just something to have on your radar if we start slowing down there. Now, typically we say that we do not want to get involved on the highest high of a trend sequence. It's bad risk reward. But in this case, it's day one exiting a balance range. Is it possible that we get day two continuation? Absolutely. Would I like to see prices hold up over 459? Absolutely. So early on in the week, any consolidation over 459 is looking ideally the most bullish, and we'll look for the upper targets that we've just listed off. The next thing I want to bring to your attention is that this is a period of range compression. You could call it balance, you could call it consolidation, and usually after consolidation, the market moves into a phase of expansion, or you could call it a breakout, right? However you want to classify that is fine. And the reason I would bring this up is because if we're exiting consolidation into expansion, and we know that there are volatility events on the horizon, is it possible that we could hit the weekly target up at 471 and go for something like a 2 sigma move in the upward direction? I really don't think it's all that far-fetched if the buyers can maintain control up and over 459. The reason I would say something like that is because, as we know off of the October low, it was aggressive, it was rapid, there was a lot of momentum. We were violating expected moves left and right, 2 sigma move, 3 sigma move, all across the board. And if the right combination of numbers and words come out of Jerome Powell's mouth on the Wednesday session, I think 471 is worth having in your back pocket. So those are the upper targets. In terms of downside, right, if we were to get a reversal out of this market back in the downward direction, it's really going to stem from a look above and fail. You want to come back down into this overall range. Now, you might be saying, well, Matt, isn't it possible that you could get a higher low here at 456.30? You're absolutely right, because we're coming from a higher high. You could technically get a daily higher low at 456.30. The risk of this situation, though, is that we then fail into the range with a lower high, and the look above and fail target is always the bottom end of the balance. In this case, the big daily inflection point at 453.90. And think about it like this. If this is already going to cement a lower high, if this is the path that we get for our bears, as soon as we break down underneath 453.90, we have ourselves a lower low, and you can check both boxes for having a very short term, but there, daily downtrend. It would certainly start to feel like this is distribution. It's going to turn into overhead supply, and we can know that we're looking for some downside targets. From the weekly point of view, 451.10, that's the retest level that we just described. Be open to buyers stepping up here. But if there's really nothing, if this is compression that's going to lead to expansion and we violate the lower edge of the expected move, we're really thinking about the top of the CPI gap as the major target. 446.15 is your number from that point of view. Let's take a look through the lens of the anchored VWAP spread on the daily time frame chart. The illustration here is just to continue to point out that buyers remain in control because shorts are getting absolutely squeezed. Any shorts who are underwater from this move, I mean, even if you had the best possible entry as a short at the highest high of the summer rally, right? Technically, you're underwater because we closed above that on Friday's session. But the beauty of anchored VWAPs is it shows us where the average price is being held from. So buyers off of the lows or any shorts who are still involved in here, this is the average position, right? It's where the bulk of the position is being held. So buyers are feeling good. Sellers, not so much. So the more time that we can spend over 459, the more likely it is that any shorts involved in this downdraft will continue to close out their positions and add buying pressure to the market overall. Let's take a look on the hourly time frame chart and get a little bit more nuanced in terms of the interpretation of the price action, and then we'll draw in some explicit pathing for this week. In terms of what happened last week, right, we were looking for the breakdown on Thursday if we were going to open underneath 456.30. Remember that the sellers had a gift as we were headed into Thursday. Failure number one to find a higher low over 456.30. Same thing happens here. Same thing happens here in the upper wick of Tuesday. Wednesday is a massive failure as well. Because the sellers were unable to produce an open underneath the zone, underneath 456.30, there was no threat for an equal low breakdown. There was no threat to bring in a daily lower low, right? So then on Thursday, notice that the pullback intra-morning actually supports off of 456.30. The buyers do what they were supposed to do, finally, right? And then we break to a higher high on Friday. Intraday, we pull back. We respect the opening print. And the doozy on Friday that really shows the strength of the buyers is that on this rebound, there was no lower high back down underneath 459. Instead, we broke to a higher high into the close of the session. So bulls do look fairly strong here, and the arguments that we made on the daily chart still stand, as long as we can consolidate up and over 459, looking for our upper targets. If we do pull back, giving the buyers the benefit of the doubt, looking for an intraday hourly double bottom or something like that, around 456.30 to trigger a long setup, but then we want to be cautious around 459. If we can poke through it, this is looking good for bullish continuation after a daily higher low. If we fall off of it, it's looking like a look above and fail. As we know, you could look for a short at this inflection point, 459, or you could look for a short back down underneath 456.30, trading back down to the bottom end of the range here, 453.90. We've talked very clearly about all of the levels that are in play. So that's possible consolidation and a break, that's possible pullback, and a reversal from here and a reversal from here. We've covered both situations. The things that the bears really want to see, and this would really be a head scratcher, is if the buyers completely fail and it's a straight shot lower with a lower high here, look out below. Any sort of H pattern, any sort of lower high underneath 456.30, I would certainly be thinking about the opportunity for a breakdown through the equal lows on the daily, bring in the lower low, kick off a daily downtrend, and we're really looking for some of those weekly pullback levels. We'll keep an open mind to 451.10, but beyond that, the CPI gap really comes into question. I know we were a bit optimistic on the daily chart, talking about 471 as a volatile target up above, but volatility can cut both ways, right? And if it happens to be in the downward direction, there's nothing saying that we can't get to the top of the CPI gap at 446.15, right? Let's auto zoom this and throw on a couple of studies to check out here. If we bring out the intraday anchored VWAPs, and we'll zoom in a little bit here, what you'll notice is that we're over all four of them. This is your CPI gap up anchored VWAP, and that's confluence currently with the 453.90. As long as we're over that, it's difficult to say that the daily chart is in jeopardy. If ideally we can find a higher low here, you're respecting the band of 3, which come from the origin of the balance in the first place, the bottom of this fake break first of all, and then this breakdown on Wednesday, right? So that is confluence roughly with 456.30 if we get the pullback first. The last thing I would point out here on the hourly chart before we get into some supporting evidence is if we take out a Fibonacci from the low of the Thursday session to the high of the Friday session, because remember, the shorts had the upper hand only if we opened underneath this zone in here. So coming from that Thursday reversal off the morning pullback to the high, where's your 38.2? You literally cannot make this stuff up. It's at the top of the range at 459. So once again, there is some confluence with all the major levels that we've been discussing today. The most bullish consolidation, break for upper targets. Pullbacks, okay. We're looking for a higher low here, something that does this on the daily daily chart, hourly double bottom kicks it off. Then we're reassessing at 459 on the retest. If we go through, fantastic, looking for higher. If we reject, look above and fail, target is the bottom end of the range. If we disrespect all of it, go lower high here, definitely looking for a breakdown underneath 453.90, kicking off a daily downtrend. Market internals are always exhibit A for supporting evidence. If you're not familiar with this screen, check out the video tutorial in the top right-hand corner. The weekly flows were extremely benign net on the week, negative 7 million. Remember that substantial reads are plus or minus 500 million. The only substantial day individually was Tuesday in terms of outflows underneath negative 300 million. The advanced decline line was fairly mixed. I would argue there might be a neutral edge here because we did fade from trend higher zone to the zero line instead of just holding a bullish read on that Wednesday session. But remember, Wednesday is when we saw the big breakdown, right? So it's not like the sellers had an overwhelming edge, but the buyers certainly don't have much going on with the Friday breakout. I mean, the advanced decline line was very mild. It's through the zero line, it's back down through the zero line, it's back through it into the close. It's not giving you too much confidence about massive continuation, and I think that this mostly aligns with the weekly thesis that we have, which is that momentum is slowing down, right? Similar comments here with very mild positive builds out of the volume flows on the Thursday and Friday session. Same thing with the cumulative tick, mild positive build on Thursday, and on Friday, the day when we broke out, the day when we made that higher high, I mean, I will give credit where credit is due. The buyers fought back from a negative cumulative build to a flat cumulative build, but to make a higher high, to break out of the weekly balance, really would have liked to see some stronger internals here. So I want to dial back maybe expectations that we're looking for massive follow through unless the internals out of the gates this week really start to show strong readings in the bull's favor. If it remains neutral, you might think twice about getting overly long at the highest high, looking for that breakout to continue. I know we mentioned on the daily chart looking for a day two follow through, but if internals do not support it, I might be a little bit more reserved in the size that I take and how aggressive I am looking for overhead targets, right? Exhibit B is always the market profile. If you're not familiar with this screen, check out the video tutorial in the top right-hand corner. Let's keep it simple to start. What's happening with the value area and point of control on Thursday? And here is the Friday breakout. Obviously, they are moving in the upward direction, especially in relationship to the Wednesday value and point of control, migrated higher and certainly migrated higher here, validating the breakout from that Friday session. So that does strike me as bullish. And one thing that we do want to pay attention to here is the rejection of spike rules from the Wednesday session. Remember that Wednesday produced this M period spike, L period single prints. And on the Thursday session, we technically opened above. So that really took the wind out of the sails from the sellers to produce that pullback we were talking about on the daily time frame chart. When we break out over these equal highs, notice that value for the most part is over the top, as is the point of control. Once again, validating that break of the daily balance range. Another thing that I really like here is the fact that the halfback of the Friday session, which is this purple line, is confluence with the two equal highs that were taken out. So if we do see a pullback, if we do see consolidation, that's the equivalent of holding up over 459 on your SPY daily chart. That would be 45.96 on your ES futures. Holding up over that would still be staying in the upper 50% of that Friday range, and that would strike me as a bullish indication. If we start to dip a toe underneath, I would bring into question the low of the Thursday session. It's not a poor low, but it does certainly lack material excess. If we take that out, this is close to the lows, the midpoint of the daily balance range. Taking that out and staying underneath really starts to jeopardize and look more so like a breakdown on the daily time frame chart. So the market profile is so far suggesting that all of the reference points that we've been paying attention to are correct. The highs of the range as half back from Friday, the lows of Thursday being the midpoint of the daily balance range. And if we were to violate it, I certainly think that you could see some aggression back through the spike from the Wednesday session. Changing gears to the QQQ on a weekly time frame chart, what do we see from a candle structure and location point of view? It's similar but different to the S&P, honestly. If we're thinking about structure first, solid green-bodied bar, most similar to the S&P, with a lower wick, same idea, same concepts. Buyers stepped up near the lows and they were able to close near the highs. Buyers are in control structurally, but what do we see with location? This is where there's a difference clearly, right? Bar to bar, lower low, and bar to bar, lower high. Now, that might seem bearish at first glance, and I suppose to some degree, just staying objective, it is bearish, making a lower high and a lower low. But if we think about the actual implications here, remember that the preceding weekly bar was an indecisive doji, and we technically had this balance range up here with two equal lows. So the lower wick of this last weekly bar technically represents already a look below and fail, which is a bullish indication. The sellers really were not able to materialize on a deeper pullback into the CPI gap range. So that does strike me as interesting and more of a bullish advantage that the QQQ has as we move into this upcoming week. If we were to take out the equal highs, we are looking for continuation in the upward direction. Just like the S&P, let's talk about some downside potential pullback levels if there is a reversal. We're still really concerned with the CPI gap close, 378.25 on the QQQ. Then anything underneath that is really a nuanced high from in here, a retest of 373.50, which is prior structure. The reason I bring both of those levels up is, of course, because we have confluence with our anchored view apps. This is closer to that 373.50-ish area. A Fibonacci 38.2 coming in from the October low to the most recent high, which is actually from last 2 weeks ago, right? Is confluence right at that number as well. Again, we're splitting hairs here, 374.25, very, very close to the 373.50 zone. The main illustration is that, once again, because we're on the higher high, even if the market does pull back, we're good to go, searching for some kind of higher low. Let's bring out the volume profile and see what we can learn when we zoom out of this chart, looking at some potential targets overhead. What we'll notice is that the cup and handle has already broken out, and the top of the handle was actually well above the top of the cup, right? This is not even close to being in play anymore. Obviously, we're over the top of this level as well. The look below and fail, dip to toe back down underneath this prior high, and now we've closed back up near the highs. If we do continue in the upward direction, I mean, not for nothing, we're having the awkward conversation about all-time highs directly overhead. There's a little bit of a volume node here at something like 398 flat, so maybe take that one with you as a potential first target, but then all-time high is sitting here at 408.71. On the QQQ daily, you can clearly see that the expected move is bullish, just like what we have over in the S&P, with the projection of a higher high breaking out of the balance range. If we're contained, the number is 399.58, and the lower edge is at 383.25. It's the top of the CPI gap and the lows of the overall balance that we've been building out. As we saw on the weekly time frame chart, this is the weekly 2-bar range that we looked below, failed, and we've retargeted the top of the range. And now the daily range has turned into this larger area right here. So we're still contained within that range, and I would argue that the trend on the daily chart is neutral. We have highs, technically a very nuanced higher high and equal high. We have lows, we have higher lows. These went to lower lows, and now we're trading back to higher lows here on the Thursday session. So trend is a bit more mixed, and for the most part, I would say that we're still stuck in a daily balance area right here. Now, this range is about 10 points, and just like we talked about over in the S&P, if we move from contraction to a phase of expansion, we're looking for a range double, and that would give you a target from a measured move point of view up around 403. Let's just, again, use some round numbers here. 393, let's call the top of the range, right? So 403 is close to a structural target that we have at 402.25. Is it possible that we get there with the volatility events that we've described so far? It's not unreasonable. You would have to clear, though, the top of the balance at 392.75. So trend is neutral, in balance, looking for a possible break with the failure that was exhibited from the sellers here to really accelerate into the CPI gap. Where do the bears actually gain control? It's really only on the breakdown back into that, right? It's a failure of this range to materialize higher through the equal lows, brings in a lower low, and we're off to the races to close the CPI gap. As we talked about on the weekly chart, you can find a weekly higher low up against 378.25. Let's remain consistent and take a look at our anchored view app spread here on the daily. I would point out a lot of the same commentary that we had over on the S&P. Everybody who's short from in here has been underwater for much longer now, but the average price is still underneath us, just fueling the fire, adding buying pressure to this market, making it easier to move in the upward direction as opposed to the downward direction. One thing that I would also point out is the lack of follow through from the sellers underneath the anchored view app from the breakout ahead of the CPI gap and after the CPI gap up. Notice that we violated and we spent some time underneath the pink anchored view app in there, and we broke down underneath the anchored view app from here. There was no follow through from the sellers. There was no rejection, no lower highs set underneath. So to me, it would suggest that the buyers do remain strong here in this daily balance range, probably favoring a possible break up and over the equal highs. You'll notice that we have a harsh white line here and a soft gray line here. Friday did technically trigger a breakout over the original balance, but we do want to clear these two equal highs if we're going to get some more substantial follow through. Let's take a look on the hourly time frame chart, go in with our explicit pathing and ultimately what's happening here from a trend point of view. And the reason I would say that the trend is different on the hourly chart, sure, you can look at this as a balance and you can say that the market's not really trending, but in the shortest duration, if we're only looking at the activity of last week, we have lows, higher lows technically, Thursday's a higher low, Friday's a higher low, and along the way highs, higher highs, higher highs. You get the illustration, right? Very, very short-term uptrend over here. Thursday finds that higher low. Same thing on the Friday session. We pull back intraday. It's a higher low over the opening print, and we close back up near those equal highs. We did not reject where there was clearly a struggle from price in the past. Notice that we stopped here, big upper wick, failure, right? Failure on the Thursday session. We did not stuff underneath that 391.15. Instead, we produced that equal high, which once again is why we're looking for clearance of 392.75 to kick off the continuation move out of the balance range here. So what do we want to see? If you are a bull, you are looking for consolidation up and over 391.15, breaks up and over 392.75, kicking off the upper targets we had discussed on the daily time frame chart. If you're a bear, you just want to see ping pong. You want to see a rejection off the top of the range. You want to come down underneath 391.15. You want to find a lower high, and you want to play ping pong. Is it possible that the daily chart can produce a higher low here? It's possible. It would be respecting the midpoint of the overall range at 387.25. Just like in the S&P, you would be looking for an hourly double bottom perhaps, some sort of inverted head and shoulders, some sort of hammer candle, the whole 9 yards. And then again, what's the concern? If we reject off of 391.15, now you're dealing with a lower high. If we can clear it with a higher low back above, you're back looking at bullish situations. If we just slash through all of this and produce a lower high here, the bottom end of the range is the target at 383.25. And because there are plenty of volatility events on the horizon, it wouldn't be unreasonable that if this happens on, say, like the Monday session, Tuesday gets some follow through to the downside, Jerome Powell comes out and absolutely hammers the market on Wednesday. I mean, the CPI gap close really isn't that much of a stretch of the imagination at the 378.25. Let's quickly take a look at the anchored view apps from the intraday perspective, and we will see if these are providing confluence anywhere. I would just argue that we're above all four of them. All of the anchored view apps, we're above them. So if we do find a pullback, again, you probably want to see buyers step up here in the cluster and above 387.25. If we fail them and produce a lower high underneath, it's kind of that nail in the coffin that we had just discussed. How about the Fibonacci from the Thursday low up to the Friday high? Any confluence here? Pretty good. Pretty good. It's not as clean as the S&P, but your 38.2 is mostly aligned with 391.15. So just furthering the bullish case that, hey, if we can hold here, looking pretty good for continuation in the upward direction. What do the market internals have to say about the NASDAQ side of things? Extremely benign reads, once again, out of the cumulative build from a volume point of view. The substantial read is 600 million out of the NASDAQ side of things. We got 32 million, not even scratching the surface at a substantial week. Tuesday also did not see substantial outflows on the individual session. In terms of the advanced decline line, similar commentary, neutral here. Certainly not validating a breakout, but we're still inside of the balance range on the QQQ daily, right? And the same commentary as the S&P, the nicey side of things with the cumulative ticks. Really not looking at anything impressive on Thursday or Friday. Remember, impressive reads are going to be up and over positive or negative 5,000 in your cumulative build. So we just didn't get that. And that totally aligns with what we saw over here on the chart with just a balance area. If we were to break out, we would want to see these internals flip to the bull side of the market. Let's finish it up with the market profile for the NASDAQ side of things. And what you'll notice is that the value area and the value area from Friday did move in the upward direction, as did the point of control. We also have an incredibly poor high from that Friday session. It's in need of repair. So something that you should be mindful of is if we repair that poor high, meaning that we trade through it in the regular trading hours session, and then we start to come back down underneath. One concern about the NQ still being in the balance and not breaking out of the balance is that the point of control and value area migrating higher technically means that more contracts have transacted higher in the overall range. And it's going to be much easier to turn these folks into overhead supply if we start breaking down underneath what I would argue in the NQ is right around that 15,960 zone. And that's been a key level we've talked about for weeks and weeks on end. So if we move through that, these folks from Thursday and Friday looking for that breakout may add selling pressure as they close out being overhead supply. So last but certainly not least for the broad market is IWM Russell 2000 and the small caps. Let's begin on a weekly time frame chart. What do we see here from a candle structure and location point of view? It's much different than the S&P and the NASDAQ. A little bit more of a meaningful upper wick, although it's certainly not suggesting a major pullback is imminent. It is there though. right? And it's a green bodied bar, minor lower wick. So I would say buyers are in control from a structural point of view. But location wise, this is where it takes the cake. I mean, look at the massive higher low and look at the massive higher high on the bar to bar count. Buyers are definitely in control on the weekly time frame chart here. The one concern though, and the reason that I specifically brought up that upper wick, is that we are near our weekly 200 SMA. That's the green moving average on your screen. And that might pose a little bit of a threat, especially if we can understand that it's paired with some other reference points as potential resistance. Let's come in with a Fibonacci from the bottom of the weekly or even monthly range at this point in time. And what you'll see is the 38.2 is sitting right there with confluence of the weekly 200 SMA. It gets better than that though. We have another thing potentially acting as resistance. If we bring out the anchored VWAPs on the IWM, you're also getting your all-time high anchored VWAP potentially acting as resistance. Again, this zone is about 186.50 up to 187. So is it logical that the weekly chart here could pull back off of this area? It's definitely possible. Are we in jeopardy of producing a weekly downtrend? I would argue not at first glance. If this is going to act as a weekly inverted head and shoulders, I know it's very sloppy. You could probably more cleanly see it on the daily chart. As long as we're over this neckline, which is roughly aligned with the 61.8, we're looking good for a potential higher low, right? We have lows, higher lows, potential higher lows if we pull back around 177, the nice round number. Notice also that you'll get confluence with your Fibonacci, or excuse me, anchored VWAPs there. You have this one and this one as well. This is the October low anchored VWAP, and this one here is of course coming from your summertime high. So liking 177 as a potential higher low on the weekly time frame chart. If we clear up the Fibonacci and instead come from the low of October to the most recent high, lo and behold, I mean, this 38.2 is right there as well, supporting the idea that if we get a pullback, this is totally healthy and natural bull flag consolidation, looking for follow through back in the upward direction. The most constructive thing that the IWM and that small caps could do is get back up towards the top of this as a monthly balance range and threaten a break up and over 200. We know that that would certainly suggest that the broad market rally is literally broadening in the scope, and it's not just being driven by the Magnificent Seven, especially over in the S&P. That becomes a little bit of a concern. It's not the end of the world, but at least worth making note of. So IWM, green shoots here, but a little bit concerned about a potential pullback for all the reasons that we've just discussed. Let's take a look at the volume profile on the weekly, because this would also align with potentially some struggles here. This is a high volume node. We've barely closed above it. Is it possible that if we dip a toe underneath it, it starts to act as resistance? Absolutely. But we have cleared the major high volume node. That's the point of control on the weekly time frame chart, right? The fact that we've recaptured this and it's mostly aligned with that inverted head and shoulders neckline would suggest that, again, there are plenty of reference points underneath us that could catch the IWM and small caps for a higher low and remain constructive back up towards the top of the overall range. Let's move on down to a daily time frame chart here and see what else we can learn about the price action. The most obvious thing that's happening here on the daily, and here's the inverted head and shoulders, by the way, kind of sloppy, but it's definitely there. There it is, right? So on the daily chart, we definitely have bull flag consolidation happening here. Last week was nothing more than just sideways price action after the big break from the Friday of 2 weeks ago. The expected move out of small caps does strike me as being, I would argue, bullish, even though you might say that this is a lower low. It's 180, 184 on the downside, and the upper edge is at 190, 175. The reason I'm not as concerned about 180, 184 and potentially breaking down from this as flag consolidation is that there's still an opportunity for a daily or even weekly higher low here. I mean, it's not that far-fetched to say we have lows, higher lows, and still higher lows if we pull back to 181. Sure, this would turn into overhead supply, and sure, we have thin structure in the breakout from the Friday of 2 weeks ago, but it's definitely possible that the buyers show back up on the retest of the breakout area in the first place, and that number, of course, is 181. But I wouldn't be so quick to say that the bears have any control here, not only because Friday closes near the highs of the little balance range up at the top, but also we'll see on the hourly chart that there was a look below and fail on the range on Thursday's low. So we'll save that for just a second. If we do get a break of this as a bull flag, measured move might suggest, if we're stacking from the bottom of the flag, 190.10 acting as your first target. If you're stacking from the top of the flag, you're definitely looking at a reach target. But again, minding the volatility events we have this weekend, totally on the docket, up around 193.50. Those are the numbers to pay attention to overhead. And again, a breakdown underneath 184. Let's say that there is a turnaround, lower high, and then a breakdown under 184, target 181. At this point in time, you would have your 200 SMA slowly crawling back up in the upward direction to provide confluence on the daily time frame chart. Let's bring out the anchored VWAPs on the daily spread just to remain consistent in our approach. And what you'll notice is that the entirety of the band is pointing in the upward direction. We're not even close to it. If we were to pull back, you're getting confluence at that 181 zone. Here it is on the hourly time frame chart. A couple of key notable items on the hourly is that on Wednesday, we had talked about how this was possibly a double top, right? And if we were to break down through the neckline 184, the door was open through the thin structure into 181. Thursday's low is a look below and fail on that level, and you can see on Friday, we find an intraday higher low pullback over 185.40. So to me, the buyers are in control for that reason, and on the daily chart, as we just expressed, we're probably looking at bull flag consolidation, looking for a break up and over 187.75. We talked about upper targets. Any consolidation that holds up here is also bullish. Delaying that breakout really starts to produce this as an ascending triangle. You could call it a bull pennant instead of a flag. It's really just wording, right? And then the bears, you'll have your upper hand if we were to get a breakdown and lower high underneath 185.40 as we just described. And really on the second go around, it's great to see this happen on the first test, but the second go around, you really don't want to be flirting with 184. That's where the door is open for those sellers to make a stand and try to push prices back down towards 181. When we get here, certainly thinking about the opportunity for a daily higher low, weekly higher low, looking for hourly trend reversals, double bottoms, inverted head and shoulders, hammer candles, the whole 9 yards that we're typically talking about. And here is your daily 200 SMA in green, right? Slowly going to provide confluence around that area. How about the anchored view apps from an intraday point of view? Let's take a look here on the small caps. I would say that this really just reinforces the 185.40. If we were to get a continued pullback, you want to stay above that to remain optimally bullish and then look for a breakout. These are kind of arbitrary in-between ranges right now. Could they produce some sort of reaction? Yes, but are they aligned with structure? Like I wouldn't, mortgage the house on, finding a pullback at this in between the thin structure, right? That's basically what I'm trying to say. In terms of your Fibonacci's, one thing to point out here is that the pullback has been incredibly healthy so far. If I just come from here to here, the 38.2 is that 184. So again, in the grand scheme of things, as long as we're above that level, there's really no reason to be overly aggressive on the downside for our IWM. Let's take a look at the internals for the Russell side of the market. Extremely neutral, nothing to write home about over here from a volume flows perspective. Nothing was substantial. On Tuesday, scratching at negative 125 million. In terms of the advanced decline line, the commentary is going to be incredibly similar to what we have over on the NYSE and the NASDAQ. Same thing out of the cumulative builds in the tick. Not much to write home about, but again, the market really didn't do anything. It just stayed contained within this range overall. If we get a breakout, of course, we want to see those internals perk up and side more so on the bullish side of the market. Let's jump on over to the market profile for the Russell. And again, not much to write home about. The only thing to take away is that value area on Friday and Thursday did migrate away from your point of control from that Thursday session. We still need to clear these highs if we're going to see continuation, but it is a sign that people are willing to transact at these higher prices. Great excess at the lows, great excess at the highs, nothing to really repair structure-wise. This poor high has been repaired, lack of material excess based on Friday trading through it multiple times. Not really concerned with anything here. I would say that the Russell is a fairly straightforward balanced trade. So jumping back on over to the platform to take a look behind the curtain at the weekly performance of our sectors, we can see that the XLC communications led the pack up 2.14%. That is a risk-on indication. Communications are a risk-on sector. Following up was the consumer discretionary sector, also risk-on, as are, of course, the tech sector components. So really substantial moves up towards the top of the list here, especially mirroring a nice breakout in the S&P. The risk-on rotation, or the posture of the market, seems correct if we are going to get continuation. At the bottom of the barrel, it's the XLE for the energy sector, XLB materials, and XLP consumer staples. All of those are lightweight sectors, and the XLP in particular is a risk-off sector. So to see those red as the market's trying to break out, again, the posture seems correct here to look for continuation. If we take a look at the structural charts by themselves, I think what we'll find as well is that a lot of these pullbacks are starting to resolve back in the upward direction. Here's the XLC, and here is a beautiful higher low over the top of the balance. We have ourselves a gap fill reversal. There's really nothing bearish to say about this chart. The only concern would be if this turns into a double top. Notice I use the term if. We would have to take out the neckline of the double top, but a lower high back down underneath 68.10. Yeah, now we've got some issues. But with Thursday and Friday's session breaking back in the upward direction, coming off of a higher low, coming off of this as previous momentum, let's give the buyers the benefit of the doubt here and retarget 71.25. Above that, we have a huge gap overhead over 72.50. The gap closes at 75.25. You don't need to be the first one in the door there, but it certainly looks good for the buyers to continue to push in the upward direction here. We know where our concerns lie. In terms of the XLY, what's happening with consumer discretionary? Bullish until proven otherwise. Just a slow and steady march in the upward direction here. Even if there is a liquidation break, not for nothing, this is a weekly inverted head and shoulders. You could get a weekly, I would say probably monthly at this point in time, monthly higher low could be produced over the gap close at 162.65, daily 50 SMA. So sure, could the market pull back? Could the market struggle as that unfolds? Absolutely. But is it going to change the weekly or monthly constructive look from the October low? Not really. So bullish until proven otherwise. Upper targets 175 and then 177.80. Next up is the XLK, the tech sector, the most important sector for the market. What do we see up here in the bull flag range? Look below and fail. Target has been achieved, the top of the range has been hit, and a break just puts us into blue sky territories. How can you be bearish on the broad market if you're looking at new all-time highs in the tech sector? It just simply doesn't make sense, especially with the failure from the sellers to even close this gap, never mind test the top of the previous balance range down underneath, right? So bullish until proven otherwise, and as a matter of fact, probably more bullish, looking for follow-through into blue sky territories. Let's take a look at the SMH while we're at it, taking a look at the semiconductors over here. And again, gap fill reversal, more similar to the XLC, honestly, but moving in the upward direction towards that all-time high. Not really bearish if we're over 161. If this wants to start drifting into a lower high sequence, we'll maybe change our tone if we start breaking down underneath 157.60. Then we have thin structure to retrace. But again, on a monthly chart, you're probably looking at a higher low down here. Can you take advantage of this as a downdraft? Can you look for a pullback in the S&P when and if that takes place? Absolutely. But we're not there yet. And again, Thursday and Friday do not suggest that that is imminent just yet. Let's move along and take a look at the XLI for industrials. We'll speed it up through the remainder of the sectors. High and tight consolidation looks more bullish than bearish, even if we do pull back. Weekly higher low over 106.50. Next up, XLF, bull flag consolidation. Anything bearish about this chart? Absolutely not. On the Wednesday session, right, technically we had a bearish engulfer. The fact that the sellers could not break down underneath 35.70 strikes me as a bullish indication. This is bull flag consolidation. Call it just a range. Call it whatever you want. Definitely sides with the buyers. If we can clear 36.30, the next major target is 37. Remember that we are unwinding almost all of the SVB breakdown from back here. Banks are stabilizing and normalizing as an investment asset class. They're quote unquote being seen now as, let's again say this loosely, safe as compared to the concerns that were back here. We've repriced all of that. This is a bullish indication, knowing that the XLF is the third heaviest weighted sector by market cap. Moving along, and obviously, right, higher low pullbacks over 35 on a weekly chart are still fine. Pullback in the S&P, yes. Bullish overall, yes. XLV, what's going on with the healthcare sector? Playing nicely inside of the midpoint. This consolidation range is where we want it to stay. We don't really want it leading the pack up and over 136.40. Nothing about this chart currently is suggesting an issue. This might start to turn into inverted head and shoulders. If we can clear that level, it's bullish pressure. Remember that this is the second heaviest weighted sector by market cap, but as we know, it typically has some more deeper defensive properties associated with it when it comes to posture. So no leadership issues yet. We'll keep an eye on it though. XLU, just renormalizing back to this area over here. Not really worth any more commentary than that. XLRE, real estate rate sensitive, of course, just inside of this balance, pulling back off the upper edge. Upward pressure, if it does continue, is upward pressure for the market. So no concerns from that point of view. Only concerned if we get back down underneath 35.80 at this point from the bearish perspective. XLE Energy, going to have a little bit of a discussion here, continued discussion around energy demands, oil demands. If you're looking at something like the CL, there's a huge issue with like global demand for energy right now. And if that sort of speaks to a global recession, maybe it's a data point worth at least considering. But as of right now, with tech sitting on the all-time highs, I think you would be hard-pressed to really build a narrative around, okay, the lack of demand in oil instantly means that the S&P needs to fall into a downtrend. It needs to go to zero, right? Those two it's just too much of a gap to bridge, right? So minor concerns, but one small data point in the full web of analysis that we ultimately spin here. Let's take a look at the CL. The reason I want to look at the CL today is because if we bring this out to a multi-year, multi-month chart as that loads up, here we go. I just want to point out, we're sitting on a huge inflection point, or at least coming into it at $66 a barrel. Sure, could this be a head and shoulders from this point of view? It's absolutely possible that this turns into a neckline if we break it, but historically, it's tended to offer some sort of reaction first. So if we can find buyers around this area, it sort of puts a damper on the whole narrative that, all right, global demand is just massively slowing down. Let's continue along, though, and finish things up with the XLB. Let's drop this back to a yearly day chart. There we are. Again, extremely lightweight sector, the lightest weight sector. There's nothing to write home about over here. Upward pressure is upward pressure. If it breaks down, it would only become a concern underneath of 79.55. Last but certainly not least for the sectors is the XLP consumer staples, and I would just say that this is just mirroring utilities at this point in time. We've recaptured this big breakdown. We're back to neutral. It's an uptrend. Upward pressures, upward pressures. Is there any issue from a leadership point of view? Absolutely not. Here's the sector ratio grid. If you're not familiar with this screen, check out the video tutorial in the top right-hand corner. For the most part, what more could you ask for? I mean, the XLK looks like a risk-on indication, as does the XLF, breaking out over this flat top, pulling back for a higher low. The XLY continuing to drift in the upward direction, recapturing with a higher low the 50 SMA, and breaking to a new higher high into the end of the week. All three of these are signaling risk on. The XLV, the healthcare sector, as we just mentioned, is the second heaviest weighted sector by market cap, but D for defensive. To see it moving in the downward direction aggressively underneath the 50 SMA, not a concern currently. The XLP, D for defensive, taking a dumpster dive over here. XLU utilities, flat, tangled sideways around a neutral 50 SMA, not a concern from a risk-off revival perspective so far. The market's looking pretty bullish from a sector ratio point of view. Let's take a look at some specialized ratios to see if these reinforce or sort of contradict the take that we just had. I would say that they all reinforce, right? XLK over the SHY, signaling a preference for risk assets, such as tech stocks versus government-backed secured loans, right? So looking pretty bullish there. Let's take a look at the XLK over the XLU. So substituting the SHY for something a little bit more risky, but still utilities are seen as a defensive play, right? You can still see the preference for the tech stocks as we potentially come into a flat top breakout that looks good. The pattern is mostly the same, finding some sort of higher low in the trend sequence around an upward sloping 50 SMA. Does strike me as a bullish indication. Next up, we have apples to apples, consumer discretionary versus consumer staples. Finally getting a more aggressive break up and out of the overall range, pushing away from that 2.38 level. To me, this is the most important bullish risk-on indication that we have from our specialized sector ratios. Let's move along and take a look at some dollar indications. What's going on with that good old Dixie? You can see that we're just struggling in the midpoint of the range. Now, there is the opportunity for a very nuanced, probably like hourly inverted head and shoulders here. Maybe you could see it on the daily. But if this holds in the midpoint of the range, technically you have like a monthly higher low. The concern, or I guess the saving grace for the buyers of equities, the risk appetite down below for equities, would be that there's certainly an opportunity to reject off the top of the range here underneath 105.65. If that's the case, it's a big time lower high, you're getting range compression, and then we'll evaluate for some sort of break. The one thing that we can continue to monitor just as a potential heads up indication is the gold contract. And remember that 2000 was a big important breakout level over here. The contract's just rolled, so this is going to be a little bit skewed, but we broke even through the all-time high, and now we're getting a retest of that 2000. So instead of maintaining a bearish stance from this pullback and saying, oh my God, gold's, it's got to go all the way back down to zero, what about the higher low retest of 2000, the breakout retest of 2000? So if you find buyers here in gold and start to push in the upward direction, that continues to put downward pressure over on the dollar and thus upward pressure, or relieves pressure, I should say, over in equities. We know that silver has been the precursor to gold even, so we'll take a look one more step behind the curtain. And what you'll notice over here is that silver did not hold the retest of the breakout point. So it begs the question, how confident do we want to be in gold 2000? You might want to think twice about it. It's definitely on the table as a possible outcome, but seeing silver slash right through, what is the breakout? Somewhere around like 23.90, 24, really doesn't give me a warm and fuzzy feeling. So does this align with a market breakout or pullback? It probably is more so aligned with neutrality in equities down below, as these things are subtly divergent. Let's take a look at the TNX, see what's going on from an interest rate perspective. A little bit of an uptick there on Friday with the labor market report, but still an opportunity for a lower high underneath 43.33. And for anybody who prefers to look at it through the lens of 10-year notes, you know that you can look at the ZN again. And what you'll notice over here is that if this is your inverted head and shoulders, a retest of the neckline is totally doable, totally still bullish, which would continue to put downward pressure on interest rates. It's very likely that Powell in the meeting upcoming is going to pause, right? We know that Powell is likely going to pause here. Let's take a look at the inverted ZT. And what you'll see is a little bit of an uptick. This would just suggest that the rate cut expectations as aggressively, at later dates have been dialed back just a little bit. That's primarily because of what the labor report did on Friday. Let's take a look at the tracker tool now. So we're basically locked and loaded for Wednesday with high probabilities of a pause, but where there's some teeter-totter is out into the March meeting, about 50-50 odds for cut versus pause. And we'll likely get some more color on that with the CPI, PPI, and really Jerome Powell commentary, which of course is FOMC on Wednesday. We'll see if the market starts pricing in that cut or says, no, Jerome Powell is going to stick to his word. It is definitely higher for longer. So that'll be the big driver of what happens this week in my eyes from the tracker tool point of view. If we take a look at what happened last week, the blowout number was over here. The unemployment rate came in at 3.7 versus a 3.9 expectation and a 3.9 prior. And the non-farm payroll also came in at a beat, 199 versus the 184 that we had as an expectation, 150 prior. And this was on the heels of a pretty big miss over in the private sector ADP non-farms. So what this would start to indicate is that more people are getting jobs and more people are keeping jobs, with that unemployment rate ticking in the downward direction. And I don't know about you, but one of the biggest hallmark indications of a recession is high unemployment. And we certainly do not have that with the 3.7 that took place during last week's trade and last week's reporting. If we look forward into this coming week's worth of trade, this is where the madness begins. So Monday, 101 is your 10-year bond. Tuesday in the morning session, we will have coffee and donuts up in the penthouse. 8:30 is your CPI, and 30-year bond is at 1. Wednesday is your PPI in the morning, and the FOMC Fed funds rate, the SEP. This is really what we're paying attention to. It's the statement of economic projections right here, and we'll show you why in just a second. But let's walk through the volatility, right? The press conference from Powell at 2:30, retail sales on Thursday at 8:30, unemployment claims at 8:30 as well, manufacturing index, and then here are the PMIs. Those are usually much more of a market mover as compared to your Empire State in the morning. So that's at 9:45, your final parting gift for the weekly session. So why is the SEP so important here? We know that the basis of the rally has mostly been the unwinding of what happened with this, right? When this SEP came out in the last reporting, which was, if we go back over here, let me just make sure I get this date right for you. The last release was in September, right? So the last September release issued that this increase, the June projection to the September projection, the median rate for 2024 had an uptick by 50 basis points. The market did not like that. That was the repricing back to 420 in your S&P 500. We talked about that. We had the interns run the math, right? And then ever since then, the market has been rallying on the pretense that the Fed will start cutting rates. And we can understand this if we take a look at the FactSet earnings reporting. The Q4 2023 earnings bottom up continue to fall in the downward direction, but the market is moving in the upward direction. What does that mean? It means that we're basically expecting a PE expansion for our market. And if the Fed does not decide to cut rates, and if we are higher for longer, guess what? This is going to be a painful realization for the market. If we scroll up to the top graphic, it's possible that the market's pricing in a little bit of a forward-looking mechanism, right? The market's always forward-looking. You can see that your 2024 calendar year projected earnings are increased by about 26 points here, let's call it 26 points. So maybe the market's looking at that and pricing that in. But as of right now, if the SEP comes out this week and Jerome Powell does not change this number right here from a 5.1 back down to a 4.6 or something in between there, if the median expected rate is still, upper fours, maybe low fives for 2024, I don't think that the market's going to react too positively to that. The market's already priced in that this is going to change. If it does not, look out below. I think that we're kind of going to look for that CPI gap close underneath us perhaps, and then reevaluate as the dust settles. So this is a major thing that I'll be watching for. Can we position ourselves ahead of it? Probably not, right? This is one of those things that we take in stride and reposition for as the day opens up on the Thursday session. Remember that this SEP is released at 2 o'clock on the Wednesday afternoon. If we move into the earnings calendar for this upcoming week, I know I mentioned two AI-sensitive earnings reports. It's going to be Oracle, and it is going to be Adobe. From a consumer spending perspective, you want to pay attention to Costco over here, and that is going to wrap it up from earnings. What about the market's appetite for risk? The TLT ratio to the S&P certainly has broken the resistance trend line, but I would not argue that this is a classic flight to safety style trade for two main reasons. If we continue to provide context around this with bonds in relationship to themselves across multiple durations here, you can see that we are falling into downtrends, and in all three instances, we are underneath a neutral or flat, slightly descending 50 SMA. What that would suggest is that the market's becoming more comfortable taking longer duration risks, and the longest duration risk asset, of course, would be equities down below. The second reason would be providing even more context with credit spreads. They are continuing to tighten by moving in the downward direction here and in the downward direction over here. So suddenly, that TLT resistance trendline break isn't so scary anymore. Let's take a look at the HYG in isolation, and what we'll notice is that we did not produce a higher high into the end of the Friday session. Doesn't mean that we have a divergence yet, but I would be paying attention very closely to roughly like 75.50. If we take that out, I would start to think, okay, maybe the market pulls back. Maybe we start thinking about the CPI gap, but so far we are still above it in the HYG. That's 70.50, by the way. Let's move along and take a look at the digital gold, what's happening with the BTC. Taking a closer look, a big breakout into this week, and as of right now, that would strike me as a risk-on indication for equities, although, as we continue to point out, not a one-to-one relationship. Let's move along and talk about market breadth here, what's going on with new highs versus lows. I want to zoom in here because although we are remaining positive, we did see a downtick out of new highs versus lows, and if we take a closer look at equities, we know that we actually produced a higher high. So breadth is technically divergent, new highs versus lows. It's one thing to have in your back pocket. It's not the end of the world because we are still technically positive, but ideally this would have continued to move in the upward direction in unison with the higher high in equities. That's number one. If we move along to the SPX A200R, stocks trading above the 200 SMA in the S&P 500, it's much more mild, right? It's not this big downdraft like what we saw out of new highs versus lows, and we're still over the 50% mark. So okay, let's dial back. Big divergence, breadth is decelerating, like maybe a little bit, but not to any substantial magnitude. Let's wrap it up in terms of SPX A's with the 50R. This is stocks trading over the 50 SMA in the S&P, and this is on a daily time frame chart, one-to-one with what we have underneath, and a similar story over here. We broke to a higher high on Friday. That's when the breakout was. We did see an uptick, but it is not as high as what we had over here. It's not the end of the world. We know that this is generally contrarian zone. It's not unreasonable for the market to pull back, but as of right now, again, this is suggesting maybe be a little bit cautious, looking for that breakout to continue with any major aggression. Are we going to, trust this as the only indication to say, hey, short this for a pullback? No, absolutely not, especially with all the volatility indications that we've discussed so far. Let's move along and take a look at the equal weight S&P 500. That's the RSP. I love that this is producing equal highs. And the reason that, I'm still thrilled with this is it's potentially offering an ascending triangle to break out of that range. The fact that it did not produce a lower low as the S&P made this higher high leaves it kind of in play to continue to reinforce the broadening nature of the market rally. We'd really love to see that move up and over 150.25. So still constructive on your RSP. QQQE, both of them weighted and non-weighted remain in a balance. Not much to write home about over here. And then we could take a look at the Dow Industrials versus the transports. This is majorly divergent. So we have the Dow Industrials producing a bull flag up here, breaking on Friday for a green-bodied bar, whereas look at transports down below. Inverted hammer, failing the reversal off of the hammer off of the previous neckline from this as an inverted head and shoulders, right? We technically broke the hammer high, saw an intraday breakout, and then reversed all the way back down to the lows. This is saying, whoa, hold your horses not so fast up here in industrials. If that's the case, you might want to also dial back expectations for your broad market as a whole, namely the S&P 500. Not so much in the QQQ. Obviously, the Dow Industrial, more so associated with the S&P stocks as a broader cohort. Let's move along and take a look at some volatility indications. What's happening with the VIX? The lowest low that we've seen since the sickness, that of course is a bullish indication. If we take a look at the VVIX, volatility of the volatility index, continuing to move in the downward direction, but not at complacency lower zone, which is 75. So far so good. This is a bullish indication as well. Then we can finish it up with volatility futures. We are clearly still in a very deep contango, so deep that we can't even see the zero line. So we'll have to readjust that as the futures roll over this week. But for the most part, this deep contango continues to speak to the lack of trust as we continue into the future here. Certainly money managers like this to allocate capital, but at a certain point, you have to stop and think like, okay, why are people so skeptical of the future? Why is this contango so deep? It's worth at least thinking about more than once. And perhaps a better illustration of this is if we bring up the skew. We haven't talked about skew in a very long time, but it's almost saying the same thing, right? You'll notice that it's elevated. It's been elevated. We've been in a deep contango. As this gets closer to the 113, we start getting concerned with potential bottoms in the market. To see it elevated speaks to a lack of trust, right? It speaks to pricing in a potential black swan event. But remember that just because this is elevated does not mean that that black swan event needs to happen. So is this concerning? Not really, but would it be healthier to be a little bit more suppressed in this range? Probably, from a confidence perspective for this market. If you've made it to this point in the video, I appreciate you coming out to the show. I know it's a late one for our weekend updates. They typically come out on Saturday if this is your first time tuning in, but we're reacclimating to the home studio. So with that said, Apple daily chart is up first on the chopping block. What do we see here? Certainly a breakout of a daily bull flag consolidation range up and over 192. We're basically looking at the flat top here, 196.75, and then all-time highs at 198.23. Those could certainly be within striking distance for the coming week's worth of trade. If we do pull back, any daily higher lows that stay over 192 look constructive for lows way down here, higher lows, and yet again another higher low. If we drop it on down to the hourly time frame chart, what do the bears want to see? Certainly the indication of a head and shoulders, aka a fake breakout up here, a lower high under 195, break the neckline, and then it's off to the races to get the retest of 192. This is still an opportunity for a daily higher low. If the bears are going to make a stand on the daily time frame chart, they really want price underneath 188 for some sort of larger breakdown to unfold and start retracing into this thin structure. Let's move along and take a look at Microsoft, what's happening with Softy here. Lots of levels on Softy, but this is no more than just a daily balance range. If we take a look at the hourly chart, you can see this is clear as day. Notice that we have lows, relatively equal lows here, here, and here. Then your highs are fairly equal as well, just barely starting to break out on that Friday session. So let's keep it granular on the hourly. Any consolidation here really reinforces the idea of an ascending triangle up and over that 373.50. You can start to retarget some of these things, but the major daily level, as we discussed, is 379. After that, it's your all-time high at 383.90. If we do move in the downward direction from the daily point of view, it's got to be a range breakdown, a failure of your previous all-time high. That's at 364.25, and your downside really opens up under 360.50. You can see the little dance that we did here, and then it's thin structure. The larger thing to be targeting is down below at 347.50. Based on what we have here, it's possible that this turns into sort of like a double bottom if we can clear that neckline and if we can start rocking and rolling in the upward direction. So one step at a time, treat it as a balance until proven otherwise. Next up, we have GOOGL. What's happening with the Goog? You'll notice that we had this big fugazi, right? It was, hey, the AI stuff is great, and then just kidding, it was all fake. So the damage actually wasn't that bad back in the downward direction. I would have thought that this gap down could have unwound much more of the move, but we are getting upper wicks here near the highs of the range and an upper wick sort of rejecting that Thursday move in the upward direction anyhow. So the main watch is the gap underneath. It's a very classic inverted hammer low breakdown. It would also be confluence of the 50 SMA. Failing both of those things should lead to the gap close. Under 134 closes the gap down to 131.80. That would be the downside trade. When we get here, certainly keeping an open mind for a possible like weekly higher low at that point. The daily chart isn't really doing much in terms of this as an overall balance. It's really sloppy, but it's there. Highs, lows, highs, right? So pulling back down into the lows, we'll look for buyers to step up. If they don't, we'll see what happens on the weekly perspective if we start retracing underneath roughly 129.25. If the buyers are going to remain in control, this really strikes me as like an attempt at consolidation. I would become much more confident if we can actually get a higher low over the 137. So remaining patient on any bullish trades here for Google. Next up, we've got Amazon, also in a very ugly daily balance range, maybe an ascending triangle if you wanted to throw a support trend line on like that. Keep it simple here. Do not overcomplicate Amazon. Looking for breakouts up and over 147.60 to stick. We have 150 as a target overhead. 153.25 is the midpoint of this as a prior range. If you were to zoom out way out on the chart, way back when we were breaking down from the sickness highs, right, the rally highs from the sickness, this was just a balance range, and this was the midpoint of that range. So the range is large overhead to be trading for. You don't have to be the first one in the door here over 147.60, excuse me. You could wait for some consolidation, then a break into that range is a little bit more constructive. So far, the daily chart is looking good, though, with this balance up here at at the highs. It, unlike Microsoft or Google, has not pulled back as aggressively, right? The bears only have something going on, I would argue, from the daily point of view. If we're under 140.50, you do start to get a daily lower low if you take out 143.30. That would be your precursor, but the thin structure really opens up underneath, as we pointed out, 140.50. Let's move along and take a look at NVIDIA, what's happening with NVDA. And you'll certainly start to get the same impressions as what we discussed maybe on Microsoft, where this could be a double bottom. The neckline would be the high of the Wednesday session, and technically speaking, we did clear it, but you're running instantly into overhead supply here. So let's take a look on the hourly time frame chart to get a little bit more granular. There's the double bottom, right? We're over the neckline. Bulls get, the benefit of the doubt here over 472.25, looking for breaks over 476. There we are. And then looking for a continuation, right? Top of the range would be enforced. Thin structure retracement through the breakdown over here. If the bears are going to have something going on, they're looking for the lower high early in the week underneath 472.25 for the retracement of this as thin structure, which was also thin structure, right? And we're retargeting the origin at 465. From there, we will take it in stride. The next larger target underneath, the biggest daily concession that we need to make is that holding 450 is bullish. This is technically a weekly high or low. It's a hold of your daily 50 SMA. If the bears really push price down underneath that, right, something that looks like this, okay, let's change tone once again. We remain in nothing more than a daily downtrend with highs, lower highs, lower highs. You would be getting your lower low underneath 450. Let's move along and take a look at Mark Zuckerberg's fantasy land. We could also say as ACL. It's recovering quite nicely. It is making a decent move in the upward direction. We cleared this inflection point here at the 329 on Friday. It is looking good. If we were to get consolidation on the daily, you want it here, and then follow through brings you to the top of this as sort of a head and shoulders. It's almost a rounding top, if you will. That would be the target there. So 342 is the move. If we were to break down, let's go to the hourly chart for this one. What you can clearly see after the intraday high or low over 329 is that you're looking for the lower high underneath. If you're trying to trade Meta in the downward direction, a retest lower high beneath 329 kicks off the thin structure retracement, and we're going back to the origin, and you get something here at 322.25. Can you get a daily high or low there? I suppose you can. You get lows, and then you would probably flip into an hourly downtrend to get there. You could get a daily high or low here at 322.25. So it is possible, although we are technically in a downtrend, and that would mark a lower high here. Correct? So that's Meta. I would mainly be trading around 329 and 322.25 early on in the week. Next up is Tesla. Totally range bound. Keep it simple. Don't do anything silly here. Over 246.25 or under 230.65. So far, we are putting in a micro balance within the overall balance in the upper 50%. So giving the buyers the benefit of the doubt as long as we can stay over roughly that 238 level right here. No need to go down to the hourly on that one. Let's finish it up with Netflix. Certainly a little bit weaker than I thought on the rebound attempt from the gap up on Wednesday. Let's take a look on the hourly. The daily is a little bit skewed there. Obviously, preceding trend was very strong, but we are in a daily downtrend. This was interesting. This is why it was interesting, right? We gapped up over what could be demand underneath us, and we did not find a higher low above. Instead, we actually had a bearish engulfer penetrate all the way through, make a new lower low, and then not really see any follow through, right? On the Thursday session, you should have been looking for lower high and then continuation. Okay, that didn't happen. Friday, how about Friday? Absolutely not. We open inside of let's just call this a range, right? Look below and fail. The target in theory should be the top of the range, right back up towards 461.10. And above that, we have a gap to close from what happened over here. Anything beyond that 467, you could start thinking about lower highs on the daily chart, right? If we do something like this, let's zoom in a little bit so this is easier to look at on the eyes. There we are. So any rebounds that offer a lower high here, you're still in a daily downtrend, right? A lower high underneath 467. So that scalp in the upward direction for the look below and fail that we just discussed is nothing more than just a scalp, exactly what we mentioned. If the bears are going to make a more strong move in the downward direction, you're looking for a breakdown underneath 447.50, thin structure to retrace, and the origin of this flag breakout is here at 437. Once again, I appreciate you coming out to the show on a late Sunday afternoon. Hit the thumbs up button if you've not already done so, and let's kick off these two trade ideas. HD is up first on the chopping block. Home Depot, what do we see? Certainly a little inside bar consolidation. It's a double inside bar consolidation up and over 324.50. So you might be saying, oh, look at this, bull flag consolidation. We're looking for a move higher. Not quite. Although that's what the pattern would suggest, I think that we're basically home from a measured move perspective. We're back to the 100% retracement of the aggressive breakdown, and I would tend to think that if these traders late to the party turn into overhead supply, a breakdown underneath 324.50 could start to get into some of the thin structure off to our left. Here it is on the hourly time frame chart. So this is market context dependent, right? If the S&P is ripping in the upward direction, please don't try to short this underneath this level. If the S&P is weak, then it's kind of game on here for HD. The first target I would be thinking about underneath would be here closer to 319.75. So that's possibly a day trade scalp, right? This turns into overhead supply with a lower high underneath, and we retarget that. From there, on the daily time frame chart, once you clear out some of the froth, if you can get like a weekly higher low pullback, put in consolidation, then sure, maybe over time we start dealing with a cup and handle, but one step at a time. HD, a little bit counterintuitive, it's a little bit contrarian here, looking for a breakdown under that 324.50. If it does continue higher, let's say you're like, Matt, I'm going to totally inverse you on this one, be my guest, do whatever you want to do. Little voice crack there to boot, right? If we're over the 3-bar range, your next overhead target would likely come from this area here at 333.90, give or take. Let's move along and give you the last trade idea. It's on none other than Visa. What's going on with Visa? You'll certainly notice that we have a balance range in force. Always love watching balances because it offers a number of different setups, and you can trade it either way depending on what the broad market decides to do. So on the daily, we can see the balance in force here. If we go on down to the hourly chart, you can see the same thing. So if we do start to break over the highs at 256.65, looking for, I think we're blue sky territories. As a matter of fact, I know we're blue sky territories. Let's go out to something like what do we want? We want a daily chart here, and we want multiple years. Let's go 15 years. Yeah, blue sky territories up overhead if we do get that breakout up and over 256.65. If we do move in the downward direction, I would say let's drop this back down to an hourly chart now that we've screwed everything up. There we go. Let's say that the downside target, not let's say, but let's point out that the downside target underneath 252.50 would give you a target here at 246 flat, basically, turning this into overhead supply, lower high underneath, then you're trading here. So just like Home Depot, that's how you get involved in the downside trade. You have thin structure to retrace, and once again, because this is a balance, because the market is trying to resolve a balance, you want to be trading in the direction of the broad market to give you an added sense of confidence. That's going to do it for today's episode of the Weekly Watchlist. If you enjoyed the video or learned anything new, let me know down below in the comment section or by giving the video a very simple thumbs up. We will be live every single day this week up in the penthouse at 8:15 to cover all of the volatility events that are coming out pre-market. We'll assess things after the close on Wednesday. I wish you all a green trading week, and I will see you in the next one.